Most of us grew up hearing the same financial advice from our parents and teachers. They told us to find a stable job, live below our means, and save every penny for a distant retirement. But in today's economy, that traditional path has become mathematically impossible. You cannot reach $1 million net worth on a standard timeline by simply hoarding cash in a bank. The financial system relies on individual cash remaining stagnant. While a bank balance feels like a secure vault, it's an arrangement that prioritizes keeping your money parked and predictable rather than active and growing. This perceived safety comes with a high price. It often forces people to stay in unfulfilling jobs for decades, trading their best years for the promise of a quiet retirement once they're old. Choosing the safe route of traditional saving often functions as a hidden trade-off. It provides the liquidity needed to keep the broader economic system moving, but often at the direct expense of your own financial freedom. To see why that trade-off is so lopsided, we have to look at the money itself. Ever since the world moved off the gold standard, we've used fiat currency. It isn't backed by a physical commodity. It holds value strictly because a government says it does. This gives institutions total control over the economy. Because the currency is paper-based, governments can decide to print more of it at any rate they choose. Banks then step in and offer to look after your cash. In exchange for your deposit, they might pay you a tiny interest rate, something like 0.5%. But the banks don't just store those dollars. They use your deposits to fund their own high-profit ventures, like the subprime mortgages that helped trigger the 2008 financial crisis. This is why authors like Robert Kiyosaki argue for holding physical gold and silver instead. They view precious metals as God's money because their value isn't tied to government promises. However, locking all your wealth into gold means you're trading potential growth for absolute security. For younger investors who can handle some volatility, extreme caution can actually hinder long-term wealth building. In the end, the banking system is designed so that you carry the risk of your money losing value, while the institutions harvest the rewards of putting that same money to work. Imagine putting $10,000 in a savings account and freezing yourself for 1,000 years. You'd emerge with $1.5 million, but that's an illusion. Due to inflation, that $1.5 million buys less than your original $10,000 would today. We see this erosion every decade. When I was younger, a single dollar could buy a movie ticket, popcorn, and a side of chips. Today, that same dollar won't even buy a small frozen drink. This happens because of three main pressures. The first is demand-pull inflation, like we saw with the recent car shortage, where a high demand for used vehicles sent prices soaring. The second is cost-push inflation. This is driven by rising expenses for raw materials and labor, like the skyrocketing costs for lumber and construction wages. Finally, there's the increased money supply. When newly printed currency enters the economy faster than we can produce goods, you have more money chasing fewer products, which devalues every dollar you own. Inflation is a multi-front attack on your net worth. It is the reason why any money left sitting in a standard bank account is slowly, inevitably disappearing. To build wealth, you have to start viewing capital as a tool for growth. When you see money as a mechanism to be deployed rather than a pile to be guarded, you can start making it work for you. You still need an emergency fund, 3 to 5 months of living expenses, kept in cash. That money should be a last resort, not a source for spontaneous spending or vacations. This chart represents the primary alternative to the savings account. Historically, the stock market has provided average annual returns of 8 to 10% over the last century. Capturing those returns is straightforward. You can use low-cost index funds, like the S&P 500, to buy a tiny slice of hundreds of major companies and simply hold them for the long term. For cash you might need sooner, money market funds offer a middle ground. They invest in short-term debt from governments or banks to provide higher yields than a savings account while keeping your money liquid. Many people stay on the sidelines because they're afraid of market crashes. They worry that taking any financial risk will lead to losing everything they've worked for. But waiting for the perfect time has a massive opportunity cost. While fearful savers watched from the sidelines, they missed out on significant market rallies where stocks jumped 30% or more in just a few months. Inaction guarantees that your purchasing power will continue to erode. Building true wealth requires moving past the comfort of a bank statement and getting your capital into the markets,